So, looking at how we pay off a loan, when we're getting that thing with the truth in lending disclosure statement, we also get a schedule there for how our payments are going to run. Because usually, if we're doing a fixed mortgage like most people do, or even with an adjustable mortgage, it's important to know what your schedule, what your payments are going to look like over time. The bank wants to know what they can expect from you, and you need to know what you're going to need to expect to give and how those things will come together, because the bank doesn't want to be surprised by you not paying off your debt, and you don't want to be surprised by the bank with a bill at random times. It's a terrible system for everyone. So instead we deal with loan amortization, which literally means killing the loan. Yeah, I know. Whoever set up this language, they put a lot more death into home ownership than may be necessary, but that's what we call this process, where the schedule that we build is what's called a loan amortization schedule. It is a schedule set up by the bank that describes the process by which the loan is paid off over time, where the amount paid off here, for simplicity, is going to be given using the simple interest formula, because as we're seeing, the interest value here does account for quite a lot, and we'll talk a little bit more about that later. But to describe those interest amounts, we use the simple interest formula, I equals PRT, where the value P refers to the amount of the loan in a given month, and the interest rates are what you'd expect, while T, because it's 1 month, is given in terms of 1/12, as a month is a 12th of a year. Anyway, let's get an example. So for this example here, we want to fill in the first 2 months for the loan amortization schedule with the following setup. And to do this, what we need to do is get the interest values for the months here, and then the payments in terms of the interest, and then the balance after the payment. So the interest for that first month there will be following the PRT formula, which is $130,000, the total amount of the mortgage, multiplied by 0.095, that 9.5% rate. Oh God, that's a bad rate. Divided by 12, because you have 1/12 there for 1 month out of a year. If you're offered a mortgage with 9.5% as your rate, turn it down. Owning a house is not worth that bad of an interest rate. But anyway, there you get a value of $1,000.17. Then the principal payment is your monthly payment, which is the given amount there of $1,357.50, minus the interest payment, which would be $328.33. So with those in mind, you can then talk about the balance of the loan, which is the principal balance minus the payment. So there, that's $130,000 minus the $328.33 for a value of $129,671.67. And those pennies are important to the bank, so they will be important to you too. And then for the second month, we do the exact same thing, except now we're going to look at it in terms of the amount remaining, that $129,000, instead of the total $130,000. So the interest for the month would be that $129,000 thing multiplied by the horrendous interest rate of 9.5%, multiplied by 1/12, because we're talking about 1 month out of a year, for a value of $1,026.57. So you notice the payment there, the interest there went down a little bit. So our principal payment, that is the monthly payment minus the interest payment. So we have our whole monthly payment, and then the amount of that goes to interest, we subtract off to get a value of $330.93. So a little bit more went towards the principal. Not a whole lot, but a little. And finally, the balance of the loan is the balance that we start with minus the amount that went directly towards the principal. So that $129,000 minus $330.93 for a value of $129,340.74. And this sort of process can be repeated for as many payments as we'd have to make here in this case, because it is a 15-year mortgage. That's 180 total payments, where by the end, you're only paying $9.76 towards interest. How nice that must feel. And a $1,347.74 balance to kill off the loan, because that's all going towards the principal. Where what we should notice here is that the majority of our money early on, the majority of our early payments, is going towards the interest value, not the principal. Like I said, when it comes to these things, because we're paying over a very long time, we accrue a lot of interest on a mortgage. That's a big reason why you might want to put more into a down payment, even if it doesn't get you a much better deal, because those interest rates can be quite nasty if you're not careful. But over time, with each successive payment, the amount in that payment that go towards interest will decrease, and the amount that goes towards the principal increases, and those ratios will start to get closer on a shorter term and or lower interest schedule. So if you have less terms, that difference comes together faster, and if you have lower interest, it comes together faster. Where a trade-off though, because you're paying off so much interest, there actually are tax breaks for people paying down interest rates. That as of December 15th, 2017, homeowners can deduct interest on the first $750,000 of their mortgage. And that actually can be quite a lot year to year on your tax bill, because many people don't have homes that are that expensive, at least not at the moment. We'll have to wait and see how the market goes in terms of home values and whether or not that tax credit changes. But hey, it is something to make up for the thousands that you put in year to year towards those payments. Anyway, that's how the process works for paying things out. So the next thing we need to think about is how careful we need to be with spending all of this money. So we're going to look at a little bit at budgeting.